Robert and Carol both think they are making the responsible choice, but one tiny fee will separate them by retirement. Robert pays a professional to manage his investments because he believes expert guidance is worth 1% a year. Carol skips the advisor, buys a broad, low-cost index fund, and handles the simple investing plan herself every year. At first, the difference looks almost meaningless because 1% never feels dangerous on a monthly statement. But compounding does not care what feels small, and fees compound in the opposite direction from your investments. So we will give Robert and Carol the same money, the same market return, and the exact same 30-year timeline. Then we will see whether Robert is buying valuable guidance or quietly giving away a piece of his future wealth. And the twist is that the cheaper choice does not automatically become the smarter choice for every investor today. Both start at age 35 with $100,000 already invested and contribute $12,000 at the end of every year. We assume both earn 7% before costs, so neither person receives an artificial market advantage. Carol pays a 0.05% fund expense, leaving an assumed annual return of about 6.95% before taxes. Robert owns the same type of portfolio but pays 1% for advice, plus the same 0.05% fund expense. That leaves Robert with an assumed net return of about 5.95%, exactly 1 point below Carol. No stock-picking edge, lucky timing, or secret fund is allowed to distort this clean comparison between them today. The first question is simple. What does 1 percentage point cost when it repeats and compounds for 30 years? After the first year, their balances still look close enough that almost nobody would worry much about the gap. Robert gets meetings, planning reports, and a managed portfolio that still looks surprisingly similar to Carol's. Carol sees a plain index fund and wonders whether avoiding the fee is truly worth handling every decision herself. After 5 years, Carol has about $208,868, while Robert has roughly $201,085 under these assumptions. The gap is only about $7,783, which can make the advisor fee look surprisingly harmless at first. Robert could easily decide that $7,000 is a fair price for 5 years of professional guidance. But the first 5 years mislead us because those lost dollars have barely had enough time to compound themselves. Every fee dollar removed today also loses every future dollar that fee could have earned inside the portfolio. The cost is not just the invoice you pay today. It is also the future growth attached to every invoice you lose. After 10 years, Carol has about $361,204, while Robert has roughly $336,040 under our assumptions. The gap is now about $25,164. Although neither investor changed the original investment strategy, Robert is not losing because his investments failed. He loses because less money remains invested and compounding. Carol is not beating the market either. She is simply keeping more of the same market return, working for herself. By year 15, the gap becomes large enough that 1% no longer feels like an invisible rounding error. The fee is now being charged on a much larger portfolio, while earlier fees have already lost years of growth. This is the part most investors miss when they compare advisor fees only with the value of this year's service. The real comparison is today's advice versus every future dollar the fee could have become if it stayed invested. After 20 years, Carol has about $872,636, while Robert has approximately $756,763 in this model. The gap is now about $115,873, enough to alter a retirement date or fund years of future spending. Nothing dramatic happened along the way. There was no crash, bad fund, fraud, or terrible investment decision. One recurring percentage point created the entire difference because compounding had enough time to amplify it. At this point, Carol looks like the obvious winner, and this is exactly where most fee comparisons end the story. But stopping here creates a different mistake, because financial advice is not supposed to be only fund selection. After 30 years, Carol finishes near $1,874,009, while Robert ends around $1,506,667 in this model. The gap reaches about $367,000, $342, created by 1 percentage point repeated across 3 decades. Carol paid less and ended with more. So if both investors behave identically, the mathematical winner is clear. A 1% advisor fee is extremely expensive when the advisor changes nothing except who manages the account. But Robert did not hire an advisor just to click buy on an index fund. And that changes our second comparison. Imagine a major market crash arrives when both accounts are large and every financial headline predicts disaster. Carol knows the textbook answer is to stay invested. But watching years of savings disappear feels very different. Robert calls his advisor, gets a written plan reviewed, and is persuaded not to abandon the portfolio in panic. If Carol also stays disciplined, nothing changes, and she keeps every dollar of her original mathematical advantage. But suppose Carol panics once, sells after a steep decline, and waits too long before buying back into the market. One bad behavioral decision can cost far more than annual fees because a missed recovery may never be recovered. Now, Robert's advisor does not need to beat the market. The advisor only needs to prevent enough expensive mistakes. The same logic applies to tax planning, withdrawal sequencing, rebalancing, insurance choices, and estate decisions. Those services have value only when they actually improve Robert's financial outcome enough to justify their cost. Paying 1% for services you never need is not automatically wise simply because the advisor is professional. But refusing all advice to save 1% is not wise either if predictable mistakes destroy more than you save. So the real comparison is not advisor versus index fund, because those choices are not actually mutually exclusive. An advisor can use index funds, and a do-it-yourself investor can still pay for occasional professional planning. The real decision is whether ongoing advice creates more value for you than the ongoing percentage fee removes. For Robert, that means his advisor must somehow recover the wealth gap through better decisions or avoided errors. For Carol, it means she must remain disciplined enough that the low-cost strategy survives stressful real-life events. This creates a personal break-even point that no simple fee calculator can determine without knowing your behavior. If both people invest perfectly, rebalance correctly, plan taxes well, and never panic, Carol should keep the edge. If Robert avoids a costly mistake because of good advice, the outcome can move sharply in the other direction. Consider another difference. A 1% fee becomes more expensive in dollars as your portfolio becomes larger. A $100,000 portfolio means about $1,000 a year before other costs, if the fee is exactly 1%. A $1 million portfolio means about $10,000 yearly, even if the planning work did not grow tenfold. That is why percentage-based advice deserves more scrutiny as assets grow and the annual dollar fee becomes visible. Robert should not ask whether 1% sounds normal. He should ask exactly what he receives for the dollars paid. Carol should not ask whether index funds are cheap. She should ask whether she can execute the entire plan alone. The best answer can also change over time because financial complexity and portfolio size rarely grow at equal rates. A younger investor with one account may need less ongoing help than someone approaching retirement with many decisions. A retiree may face Social Security timing, taxes, withdrawals, Medicare costs, and estate planning at the same time. That does not prove a 1% fee is justified. It simply means the service must be compared with its real value. Some investors may prefer hourly or flat fee planning instead of permanently giving up a percentage of their assets. Others may willingly pay an ongoing fee because delegation and behavioral coaching are worth more to them than cost. The hidden mistake is treating the advisor decision as a moral choice between being smart and being irresponsible. Robert is not foolish for paying for help, and Carol is not reckless merely because she chooses to invest herself. The numbers only show what happens when investment outcomes remain identical except for the recurring advisor fee. Under this setup, Carol ends about $367,342 ahead after 30 years using the stated assumptions. But real life adds behavior, taxes, planning complexity, and mistakes that a clean spreadsheet cannot price perfectly. So before hiring an advisor, translate the percentage into actual dollars today and projected dollars decades later. Then list the specific services you receive and ask whether those services realistically justify the compounding cost. If the answer is only portfolio management, a simple low-cost strategy can make 1% extremely hard to defend. If the answer includes valuable planning, you cannot execute alone. The cheapest option may not be the best option. The lesson is not that every advisor is overpriced, or that every do-it-yourself investor will automatically win. A tiny percentage can cost hundreds of thousands, while one major mistake can erase just as much future wealth. Robert paid for protection from decisions he might regret. Carol kept the money, but accepted responsibility for them. Both choices can work, but only one question reveals which side of the equation actually fits your financial life. Would you rather guarantee the 1% cost, or trust yourself to avoid the mistakes that advice might prevent?